Hello, everyone. It's my pleasure to have Chris Vermeulen, one of the best traders in the market that I know, and founder and chief market strategist at the technicaltraders.com on our channel today once again.
Yeah, it's a pleasure to be back. It's I'm excited to share some charts and share what I think might be coming around the corner.
Now, I do remember that you mentioned in the past interviews that we may be seeing another all-time high before a major crash happens. And it does seem like the market is getting close to the previous all-time high we had in 2021 December. Now, I personally think that we still have issues in the economy, such as, the high Fed fund rates, still high inflation. I think also many companies and banks are struggling with enormous amount of debt, causing massive layoffs. But even in this environment, the market keeps going up. Can you share why you think the market keeps going up, although we still have many issues? And if it's also possible, how high you think the market may go?
Sure. Yeah. Well, let's. I'll pull up my charts and we can kind of walk through those. If we take a look at the SP 500, so naturally the market climbs a wall of worry. I don't know why, but the market goes up when everybody's fearful. It's just the way the markets have always seemed to move. So we've got the COVID lows. We had all kinds of worry. The craziest event ever. We had one of the biggest rallies. And then 2022, we had a big correction. And this year, I mean, we've just been on this tear with the stock market just constantly pushing higher. And we're threatening, we're in striking distance potentially by the end of the year to actually hit new all-time highs. I think one of the big things right now in the markets that's driving it higher is really just a big handful, big tech, semiconductors. Big tech companies are such a heavy weight in these markets. When we look here at for the SP 500, it's come up, put a major top, had a pullback, and it's working its way back up. And the Nasdaq is even stronger. If we take a look at the QQQ, it's even closer to all-time highs. Looks really bullish, but these are very heavy in tech. And if we look at the Russell 2000, which is the small cap stocks, they are struggling. They put in a major top, they broke down, and now they're really just channeling in this big sideways range. In fact, they hit new multi-year lows really just a month and a half ago, just pierced, and then they've had a bounce with the stock market rallying. So the small caps to me is what the majority of portfolios, the majority of investors are experiencing, because that's what most stocks are doing. Most stocks and sectors are beaten down really hard. If we take a look at the ARK ETF, you can see how they are beaten down and they're just flatlining like the Russell 2000. And this is what most stocks and sectors are actually doing. But when you look at just the Nasdaq, you look at the tech stocks and the SP 500, they're up near the highs. There's not a lot of strength behind this market. It's a bunch of big companies. The I think AI movement has really sparked a big push of investors piling back into tech. They've definitely been pouring back into the growth stocks. We've had a big run in all the ARK ETFs recently, but really they're just rallies up to resistance. I think that's why we're seeing just the markets move up. It's a tech AI kind of driven bubble, and the markets are drifting higher and it's starting to suck people in. I think if the stock market hits new all-time highs, it is going to be a very explosive move in terms of, I think there's a lot of people betting on a major financial collapse, and they're going to be short the market, which means if it hits new highs, they need to get out. And so we're going to see a huge short squeeze, which is exactly what just happened in gold in the past week. And then we could see, once that wave of short covering kicks in, and anybody who's not long this market sees it hitting new all-time highs, they're going to be like, I have to get in. They're going to have FOMO. They're like, I can't miss out anymore. And they're going to get in. And then once that momentum fizzles out, we're going to see potentially a huge reversal and a big sell-off. And most people are going to get out of their shorts at the worst time. They're going to get reinvested in the stock market right near the high. This is what the market does really the best. It sucks people in at the worst price, buy high, and then they panic out and sell low. We hear it all the time, but it's the reality of it. And this being potentially the top of a major bull market, there's so many people are going to feel the brunt of this, potentially 12, 24 months from now, if the market has a multi-year sell-off and their portfolios are down 40, 50, 80%. So it's going to be very interesting to how all this unfolds.
So a very interesting point that you just made is, correct me if I'm misunderstanding, but you're saying that a lot of people are thinking that the market will go down and there's a lot of shorts, but if we hit another all-time high, these shorts will have to cover their position. So that would cause a short squeeze. And at the same time, the general investors, if they see the market going all-time high, they will FOMO in. So it's a combination of covering the shorts and also the retail investors coming in with a FOMO that may cause maybe something like a melt up before we have a major crash.
Exactly. That's yeah. And that's how the market sucks people in. Typically, we see some of the strongest moves happen just before a trend reverses. We see that on like panic washout lows during major lows. We typically see it during major highs. We'll see a really strong push and run. Everybody gets in and then it dumps out. So that what you just said is exactly it. You literally have a wave of people who have sold short, meaning they sold shares they don't own because they want to buy them back later when the stock market is lower priced. So they sell them for a high price. They get all that money in their account and then they'll buy them back later at a cheaper price and they get to keep the difference. So those people are going to have to cover. And then there's also some of those people are also going to say, well, not only do I want to cover, but now I want to buy a long position. So those people can actually buy double of really what they initially their position was. And then you also have the average investor who's not in this market, who's been holding out and watching this wall climb this wall of worry. They're going to be like, oh, I can't take it anymore. I have to get in. It's hitting new all-time highs. I mean, there's no overhead resistance. And that's what sucks the rest of them in. So there's like three waves of buying. If we take a look at the gold chart, obviously this is the daily chart. We saw the market run up and then break to new all-time highs. And then on this daily chart, it got slammed. It's had a little bit of a bear flag and it's starting to pick up speed to the downside. Now, the best way to see this is if we go to the monthly chart and we look at these highs. So these are all the highs. This is where gold broke out. And this level here through this chart, we can actually see that on the 10-minute chart. If we zoom into this 10-minute chart, you can see this blue line right across here is where gold hit new all-time highs. So there was a bunch of people, a bunch of money piling in, but as soon as it hit new all-time highs, it was an instant automated trading orders of shorts getting filled or covering their shorts, people buying in saying if it hits this level to a new all-time high, automatically my broker is going to buy me a position. And when something goes straight up and everybody does the same thing, it usually means it's like an exhaustion move. It's like the breaking point. Everybody couldn't take it anymore. They have to get out or get in of their positions depending on what side they're in. And then suddenly the market goes in the opposite direction and it does it on huge volume. The volume we've seen in the last several days pretty much dwarfs all of these other little trading days in terms of volume. So we've got massive volume that's trading like around the clock with what's going on. So this is what could happen to the SP 500. It hits new all-time highs. We see huge short positions. I think a lot of institutions have big short positions. There's going to be a ton of them that want to cover. There's going to be a lot of individuals. And then there's going to be people who want to get long this new bull market that it'll be this is it. It'll be headline news everywhere. Stock market hits new all-time highs. We're back in a bull market, technology leading the way. It's literally going to be like the ultimate FOMO. Whoever's not in is going to have so much FOMO, they have to get in. That's the kind of perfect storm that is brewing. Gold just had this like kind of shakeout and this fake out, and now it's going to take some time to recover potentially. And the monthly chart of gold, when we have one of these reversal type bars, we tend to see this is a reversal bar. So it ran way up here and then it's selling down. If it closes down like this for the month of December, which we still have lots of time left, we generally can count for usually 3 more bars that will probably be to the downside. In some cases, it could be many bars to the downside. Each bar is 1 month. So the pullback from this high to this low was about 20% and another 20+%. And this was like almost 12%. So these are pretty big pullbacks. So I am bullish on gold long term. I do believe we are in a major phase in gold, similar to kind of the 2001. I think we've started this move and gold consolidated just before the stock market went into a bear market phase. And we had gold break into a bull market back in 2019. It's rallied up. It's been consolidating. And this is a prime time for precious metals to actually do fairly well for a few months, just like we saw back over here just before the economy fully peaked and we went into a recession and we went into a financial reset. Gold, silver, and miners do very well for a few months. And then when there's a collapse, they do get pulled down with the market temporarily. And so I do think eventually, even if gold does rally here, I think we're going to come back down into this range before we take off for the next major multi-year run in precious metals.
Wow, very interesting, very informative. This is really helpful for me. A couple of months ago, the market was falling hard in the case of the SPX. And I think the index also went under the 200 SMA at one point, and a lot of investors were worried. Is there a way that you could tell whether these downtrends are temporarily pullback or if they are the start of a big crash? And are there like specific indicators that help you determine the difference between a market going down for a pullback versus an actual market crash happening?
Yeah. So again, it really breaks down to the style of if you're a very short-term trader, if you're like a swing trader, an investor, there's ways to identify trends on all of those time frames. So, my time frames might not be match somebody who's really, really active, but here's the 200-day, this blue line is the 200-day moving average. We did pierce through that. So if you're a long-term investor, I mean, we are seeing the SP 500, the trends moving up. We can typically do a few different things. We can take these lows on the market. We can use a Fibonacci retracement. And if we come up to this recent high and carry it forward, we can see the SP 500 pulled back to more or less this 318 and the 50% retracement. And this is the sweet spot for a pullback. Typically, if the market pulls back and finds support above the 50% retracement level, I find that to be very bullish, and then allows us to calculate, a new upside target for the SP 500. So, the trend is up. This is a nice multi-wave, 5-wave pullback. That pullback actually happens to be right through all of this noise. That is not a very straight line, but if you notice, there's consolidation, there's some highs through here, some more consolidation through here, highs, a support level. So it came right back down to test this initial kind of high volume breakout zone, and then it's just rocketed higher. If we just zoom into this year's price action only of the SP 500, so we've got this move up. We've got it topping out in June, July, and then it comes down to a multi-wave sell-off right into the end of October. And then we go into this year-end rally, which we still have December left. But if you just look at this overall price action, take a look at the SP 500 seasonality chart. We go up, we top out June, July, we pull back usually to the end of October, and then we go into the end of the year rally. So this whole year has been, seasonality-wise, has been moving very similar to what it does on average every year. And this pullback, this pause that we've had in the SP 500, the NASDAQ over the past week and a half is exactly what happens, the first week of December. And we're about to go into this final potential squeeze and push higher, which could be very, very explosive. And it might end up carrying a lot of power behind it and sending stocks higher, growth stocks higher. So it's pretty exciting to see what's going on, how things are unfolding. Everything is pointing to higher prices right now. And typically what we see for sentiment is we tend to see red and orange bars, usually near lows. We usually see them kind of near lows. And then the market usually rallies and takes off. During an uptrend, you usually see them on the lows and then it takes off. What's really interesting is everybody is actually very defensive here. They're very scared. They're actually betting on downside. Usually this means the market's actually going to go higher. So what's really exciting is we've had this super powerful rally out of October. And this is like a little running correction. If this starts to break to the upside, I feel like there is going to be a huge rally, which will blow us past all-time highs on the SP 500. This is telling me that everybody is betting on a very sharp pullback. They're expecting lower pricing. And if most people are offside, they're expecting on lower pricing, the market's probably going to go the other way. And it's going to create the short squeeze and everybody to cover and then to buy in. So there's a really, really intense scenario here for the next 3 weeks of this trading year, where we're going to have either a massive rally or we're going to have a massive collapse. And to understand that either one of those is about to happen, you have to make sure your positions are managed so that you don't take a beating if you're on the wrong side of that. I learned a long time ago the 4 stages that the stock market goes through, which is this graphic I think you and I actually talked about and covered last time, which people can download on my website. So if you can understand what stage you're in, you know what strategy you need to trade. You'll also understand what to expect from the markets, if it should be a choppy, difficult time, or if it should be pretty smooth sailing. And so like this dotted line here, like this moving average, Stan Weinstein teaches this in his book, How to Profit from Bull and Bear Markets. And more or less, if the moving average, the 150-day is moving up, price is generally above it, you're probably in a stage 2. When price is below it, or the moving average is topping out and moving moving down, and you're kind of in a mixed signal. So you're either in a stage 3 or a stage 1 type of formation. And then when they're sloping down and prices consistently below it, you're probably in a stage 4 bear market or financial reset. That's why I like the 150 day. I find when you look at a lot of charts and the indexes, you'll find price actually finds much more support off the 150 day than the 200 day. But the 200 days is one of those things everyone seems to use. And they say the golden cross and the bearish cross, which is, when the 50 day passes up through the 200 day. I mean, all those things are it's such an old, slow time frame. I don't like to kind of follow what everybody else does. I like to try and find something usually a bit shorter time frame, and that seems to work consistently through time versus just 2 moving averages crossing over doesn't mean a whole lot to me. I always talk about the stock market. It's just like the ocean. And if the stock market's going up, you want to be looking to own stocks. If it's going down, there's no point in being diversified and owning all kinds of stocks, because pretty much all boats go down with a falling tide. Well, almost all stocks go down when the stock market is in a bear market. So to me, there's no point in holding something during this phase. You're better to go find a different asset, which the US dollar during this time frame skyrocketed up. And it's a very slow, consistent way to take advantage of the market. So it's important to know, are you in a stage 2? Are you in a bear market phase? I believe we're actually in a very big stage 3 top still. I actually think we're going to come up and we're going to poke to nominal new highs, but overall, it's probably going to be a major, major double top. And then we're going to see the stock market, I think, sell off very big down the road, but one bar at a time. I don't try to pick tops or bottoms. That's the nice thing about technical analysis is instead of just trying to trade chart patterns and pick tops and bottoms, I literally just let price tell me which way it's going. I look at a lot of different things, intermarket analysis, a lot of different markets and commodities are related in some way. And if you can see if money's flowing into stocks or into different assets, you can tell how much momentum there is behind it. So a lot of times we actually sit on the sidelines avoiding a lot of the daily noise and chop that people usually get caught up in. And they get so emotional. Literally, people watch the charts every day, tick by tick. They refresh all day. They are so hypersensitive to the tiniest little piece of news and the fear that surges through their veins and their frustration, and they don't know what's going on. I mean, the worst thing they can do is watch the charts and listen to the news. So that's kind of my take.
So during 2023, the Magnificent 7 or 10 tech stocks did rally, and I think that's why the market did really go high. But I do understand that there's a cycle of money, or the money transfers from this asset to that asset. There's a cycle. And was wondering if you think the institution will keep piling money into the big tech stocks that are rallying right now with a lot of hype in the news, or do you actually see that the institution money is transferring to another sector right now and will happen in the first quarter of 2024?
Yeah, it's hard to tell what the institutions are really doing. We really need to big volume on the down days. So I call that distribution selling. So if we have a bunch of big down days, and those days, the trading volume is really high. That means there's big funds unloading blocks of shares and lightening up their portfolios. I would almost think a lot of institutions, big money players, I think we're going to see year-end window dressing. So the technology space, for example, this is the tech sector. It is actually already broken to new all-time highs. It broke through it. We had a bit of a pullback in July, and now it's breaking back up and it's hitting new all-time highs. So what we see with a lot of funds and advisors is they have a lot of their clients in the wrong positions, and they haven't kept up pace with everybody else or with the overall markets. At the end of the year, we start to see a lot of the poor performing assets get sold down, and they're going to rotate their clients to hold the tech sector, big tech companies, so that year-end analysis, when investors get the report, they'll be like, my account didn't do very well, but I have all the big stocks that perform the best, so I must have done the same as everyone else. And it's called window dressing. You just kind of pull the wool over everybody's eyes. So we could very easily see more money start to roll into these big techs, because a lot of advisors are going to shuffle everybody over. So, the clients think that they've already held all these, they've done just as well as anybody could. So that, I think, is going to drive the market higher. And then when we hit these new all-time highs, I feel like that's when we're actually going to see some big institution. We're going to see huge selling volume. We're in a bullish phase right now. It's not a really strong bull market. It's not a broad market rally. It's just tech is rallying, but it's holding the indexes up, and you might as well ride it until we see that reversal and things And that's when they're going to start having big thumbs on the sell button and big block orders going through. But I think the big institutions will be riding this up saying, we're going to be able to unload at a great price when once this momentum starts to stall out and a top starts to get put in.
Chris, this was a lot that you covered with the charts and the economy, and I really want to thank you. But before I wrap up this interview, I would love to hear more of your strategy on asset revesting and how you are actually helping your members or your subscribers.
Yeah, so asset revesting, like the core premise of it is we only hold assets that are going up in value. So I don't believe in the buy and hold strategy because simply if you have a diversified buy and hold strategy, first of all, if you just hold through everything, it's going to be one wild roller coaster. If you're close to retirement or retired, the last thing you want to go through is a 5 or 10 year market correction and you don't really make any money and you watch your value go down. So I think the buy and hold is just a dangerous roller coaster. The older you get, the more dangerous it becomes. And I don't believe in diversification because if you diversify across everything, then you're going to have all the stuff that's doing really well, but then you're also going to have all the stuff that's just doing terrible. And so you've got big losers, you got big winners, and they net out to give you that really poor average annual return for the buy and hold investor, which is depending on your time window, it's like 4 to 8% return, which I mean isn't the greatest. You can do a whole lot better if you literally just move into an asset class that's moving up and manage that position, lock in gains, move your protective stop up. And when it starts to show signs of weakness, you move out and you move into a different asset. And so asset revesting is we've got a hierarchy of positions. So the most volatile asset is at the top. So it's like the US stock indexes. If they're favorable, we want to own them because they have the most liquidity, the most volatility. They're a nice big basket and we can play those ocean tides. So we would move all of our portfolio into the equities market. If they fall out of favor, they're going down, then we move to a slower moving asset. Could be US treasuries, which haven't been in favor for a while. Could be the US dollar index ETF, which is super slow. And the nice thing about it is there's a bullish dollar ETF and there's a bearish. So it really doesn't matter which way it's moving. We can potentially benefit from these. And if you go from volatility, stock market, say, is the top volatility, bonds is like half of the volatility of the stock market. And then the currency is like about half of bonds. So as the market gets crazier, we're moving to slower and slower moving assets, and we're moving to different assets. So I think what a lot of people don't understand is if you own 100 stocks and people say, oh, I'm diversified, I got 100 stocks. I'm like, actually, if that's all you own, you're actually not diversified really at all. If you own stocks, that is one asset class. Bonds is another. Currencies are a different asset. Real estate is another. And so all these people have this false understanding that they think owning 150 stocks and all these crazy sectors, they think they're diversified. And it's really all they're doing is putting these faster moving, highly leveraged positions in their portfolio that when things go south, they actually lose a lot more than if they just stuck with the index. So people are loading up on very dangerous portfolio positions. And if most people who have a passive, like who is a passive investor, with like an advisor, they're all going to have the same portfolio, give or take. It'll all be made differently, but they do the same thing. It's going to be like a 60-40 portfolio, somewhere around there. If these people go to their advisor and say, what is the most, my money is invested right now with the strategy. What is the most, like the biggest drawdown, the biggest loss I could take if the market tanks? And I don't think a lot of investors ever ask that question. And if you're doing the buy and hold, it'd be like, well, you could lose 40% or more of your money in like an 8-month window, potentially. And if most investors heard that from their advisor, they'd be like, no way, I don't want that strategy. I'm bloody retired. I'm not going to risk all that. And so that is the one thing that I don't believe in is the buy and hold diversified stock and bond portfolio. And then there's the other extreme, which are active traders. And there's numerous studies that say if you're an active trader and you trade for 300 days or more, even during a bull market phase, 97% of people lose money. This is across North America, Taiwan, Brazil. They've done multiple tests. Emotions get in the way. People just don't know how to manage risk and money. I've talked about it many times. There's no interest in people talking about money management, like position management, risk management. They all want to just swing for the fences. They pick a random number to throw into an ETF or stock, and they don't understand the risks by doing that. So the more you trade, the more likely you are to lose. If you do absolutely nothing, you're going to have average crappy returns. You might not have the money when you want it later on in life. It's a roller coaster ride. Asset revesting, is right in the middle. We do like 5 to 12 portfolio adjustments a year. We're in one ETF at a time. It doesn't get any easier. And we literally just are moving into assets that are going up in value. If nothing meets our criteria, we move into an ETF called BIL. BIL is the symbol. And we just collect daily interest. So while the world's falling apart, we're sitting in interest, building our account day by day, waiting for that next set of waves to roll in that have a clean, high probability position for us.
Chris, thank you very much for your time today and your great insights. I think it was very helpful for me, and I think it'll be helpful to a lot of my subscribers that are watching this interview. So thank you very much. And, in 2024, I really look forward to talking with you again about the market.
Great. Well, appreciate it. It's always a pleasure to be on your show and share some insights. Hopefully everybody finds it helpful and learns something.
All right. Thank you, Chris.
All right. Take care. Bye-bye.
Bye.